Robert, in your book, Conquer the Crash, you state the main goal, this is a quote, the main goal of investing in a crash environment is safety, unquote. That reminds me of an old Mark Twain quote when he said, I'm not interested on a return on my capital as much as I am in a return of my capital. Many of our listeners, like many Americans, have been in capital preservation mode for some time, and they're not in the mood to lose any more money. What are some of the strategies that you are recommending for individual investors who want to preserve their investment capital, given your economic outlook?
Let's start with what people shouldn't do. They definitely should not do what the public dives into and loves. When the public loved tech stocks in 2000, that was absolutely something to avoid. When the public was getting rich in real estate and decided that was how they were going to retire, never have to work again, that was a market to avoid. When the Dow was at a new all-time in '07, same thing there. When commodities were running up and people said, peak oil, we'll never get enough oil, it's going to go to hundreds of dollars per barrel, and we're going to run out and go back to the dark ages on that basis. We saw a complete end of a beautiful five-wave structure under the L8 wave model, and of course, oil went down 78% in 5 months. Now we're in another trap, and most people can't see it. They think they're being conservative because they're not pouring into the stock market as they used to. So what are they doing? They're chasing yield. They're buying a tremendous amount of low-grade corporate and municipal debt, as low as BBB and BAA type of IOUs, because they have a larger return. But as you just said, it's not the return on your principal. Are you going to get a return of your principal? And I think in this case, yet again, the public is going into an area that's going to hurt them very, very badly. Don't worry about the return on your money. The main thing here is to maintain your purchasing power. Try not to lose anything, because in the next wave down, people are going to be losing so much money in the financial markets that the people who can hold on to every dollar that they have are people that are going to end up living like kings relative to everyone else. So as you say, the main goal here is to be as conservative as possible. So what do you do? How do you go about that? I think the number one thing is to make sure you don't have any of the traditional investments at all. You have to be in extremely safe institutions. Most of the banks I do not trust. I've got instructions in Conquer the Crash. If you want to find some really safe banks, you will find a few of them overseas with very high liquidity ratios, very small loan out ratios. In the United States, banks are basically 100% lent out. They don't have very much cash in the vault at all. It's all in mortgages and other kinds of loans. So you don't want your money in banks, and forget the idea of the FDIC. You know, a lot of people say, I don't have to worry because the FDIC will bail me out. I think the amount of trouble that the banks are going to get into is so large that the FDIC is going to basically have to put on the brakes and say, look, it's going to take us years to sort this out. Please be patient. You don't want to find yourself in that position. So as someone who's expecting a tremendous deflation or a tremendous decline in the total value of outstanding debt, I think the main market you want to be in is the safest possible cash and cash equivalents, such as treasury bills. I've also recommended Swiss money market claims from time to time. For example, last June, when the dollar was topping out, euro and Swiss were bottoming, I said this is a good time to be in the Swiss franc. That's changing at the moment. I've also recommended over the years, at what I thought were the right times, to buy gold and silver. The last time I bought silver was in 1993 when it was near $3.50 an ounce, and recommended people buy bags of silver and put them in your attic or put them in your garage. We might need them someday. So we're in a very conservative state of mind. I think one of the greatest buying opportunities of all time is coming up this decade, and we just want to be ready for it.
Robert, what about the real estate market? What's your economic outlook mean for the U.S. real estate market?
Well, that was the market everyone believed in, and it really started topping out in 2005, which is about 3 years after I came out with Conquer the Crash. And I have a whole chapter on real estate, and I said, don't touch it with a 10-foot pole. Why? It was the most ballooned market in the world. People were buying real estate at that point with nothing down. In other words, 100% credit. In some cases, it was actually 105% credit because they needed money to pay the lawyers and the closing costs in the first few months of their mortgages, which was just amazing. that was the biggest bubble I think that's ever occurred in finance. So that's probably the single most dangerous place there is. People think that we're on a short-term turnaround because we had, a bounce or something in new housing starts, but nothing that I see gives any indication that we're anywhere near. We were at least 10 or 15 years away from the final bottom in real estate prices and the beginning of any kind of new boom there. So if you're going to avoid one market above all, it's real estate. And the other problem is, I'm sure you've talked about this on your show, is that it's illiquid in bear markets. At least if you decide you're wrong in a commodity market or the stock market, you can get out.
Anyone with a house on the market can testify to that, Robert, right now in this scenario. Robert, gold has had quite a month, let alone the last 10 years, one of the biggest bull markets of the last decade, if not the biggest, and silver has just hit a 30-year high this week. You mentioned gold and silver. What's your take on investing in hard assets during this deflationary depression that you see upcoming, like gold, silver, even agricultural commodities? Even though we may be facing a deflationary depression, do the fundamentals underlying these still make them good investments?
Well, everyone knows that precious metals tend to do well during inflationary times. And I've also heard an argument, they also do well in deflationary times. Now, you can't have it both ways, not in my book. If inflation means the creation of more purchasing media, such as credit and base money, and metals respond to that in some way, then I think if you reduce the total amount of purchasing media, then you can't argue that metals are also going to go up for that reason. So I did a study to decide to show how metals do during expansions in the economy versus recessions. If you're looking for a depression, you shouldn't depend on gold to go up and make you rich during that period either, because gold tends to go sideways during recessions and tends to be very strong during expansions. And that's one of the reasons gold has done very, very well since we came out of the recession back in June. And when we were in expansion all the way from 2001, when that recession ended, all the way into late 2007, early 2008. These were times when gold did very well. We're still in this topping process, this giant head and shoulders. This lasted 10 years in the stock market, and every time the market rallies, this is a reflationary period. Confidence is returning. If you've watched the spreads in debt, you find that low-grade debt now has creeped up to the point where its yields aren't that far away from the high-grade debt yields. This is another indication of confidence. The rally in the stock market is an indication of confidence. The fact that we have gone up for a year and a half in stocks is why the economy has continued to expand, because the economy lags stock prices. So these are all things that have made gold go up in the past. But in the future, I think we've got many things working against it. The first one is the deflationary wave that I think is about to resume as soon as the stock rally peaks out. The last time we had a deflationary wave, which was in 2008, silver went from 21 down to the $8 area. That's a pretty big drop. We've also got, in my view, too many people bullish on metals now. Back in February 2001, you couldn't find a bull on the metals. Even the industry people were hedged as strongly as they could be. The mine owners were hedged well into the future. Barron's ran an article in February 2001 and could not find a single positive outlook from anybody in the industry or out. And now it's the opposite. Every street corner's got a sign, "We buy gold." People are pointing to gold making new all-time highs. But you don't see a whole lot of discussion about the fact that the other metals aren't at new all-time highs. Oil's not at new all-time highs. Despite the rallies in the agriculturals, they're not at new all-time highs. Stocks aren't at new all-time highs. So it's not a general inflationary push that's making gold go up. It's a focus. It's an investment focus, I think, just like oil was in 2008 and just like the tech stocks were in 2001. So with the dollar back to extreme negative, extreme pessimism right now, just as it was in late 2009 and early 2008, that's the flip side of what people feel about the metals. I think it's late to be bullish on the metals, and I think probably a few years from now they'll be lower than they are today.